Okay, we talk about Basel III, a global regulatory framework for more resilient banks and banking system. So, the topic addresses changes made by Basel Committee on Banking Supervision to address risk in the banking industry. Now, the Basel III framework seeks to promote a more resilient banking sector. Changes are broad and encompasses increases in both quantity and quality of bank capital, as well as strengthening the risk coverage of the capital framework. The committee has included buffers to protect bank in times of significant stress. They also require a simple non-risk based leverage standard for banks and will require uh, the banks to maintain short-term and long-term stable funds to protect against liquidity crunches. One of the key problems of recent financial crisis was how quickly it spread from financial sector to real economy. And the committee is providing mechanism to address systematic risk in financial market. And the changes will be proposed in a few years, uh, which are like in the future. So there's some time to implement that. Now the whole idea here is to uh, take 3 points. The first point is that the bank's capital should be of high quality. That's something interesting. Again, linked to that, one of the scenarios that comes into play when things become tricky is liquidity. And the third is that the bank need to manage its short-term and long-term against a liquidity crisis, and understand how systematic risk or how anything that happens with bank will affect the systematic risk, or rather the vice versa, where systematic risk could affect the bank. So let's look at the reasons for the changes implemented through Basel III framework. So representatives of central bank and bank supervisory authority from across the globe made up the Basel Committee on Banking Supervision. The committee has instituted a broad range of changes enacted to strengthen both capital and liquidity position of banks worldwide. The whole idea is to promote a resilient banking system. Now it's interesting to understand that bank by its name could suggest any financial institution that has regulated capital. So even a prime brokerage who provides brokering to hedge fund would come under this definition. So any part or wing which provides those quantitative index or ETFs comes under this definition. So it's a broad term that comes into play. And there are several reasons the committee has acted at this time. The reason are excessive on and off balance sheet leverage at a global level, and erosion of amount of capital and quality of capital base. This is just the repetition that I talked about. The quality matters a lot. So like if they were holding MBS or if they were holding some securities AAA rated, it still is risky, and it's risky because of the liquidity risk, not because inherently it will be trouble to sell it, but only during the liquidity crisis. Now, insufficient liquidity at many banks made it impossible for the bank system to absorb the shocks and ultimate trading and credit losses. So that's why liquidity is known as the ultimate risk, and that has remained one of the major focus here. Then the inability for the bank to handle large off-balance sheet exposure that has been created over the time, but had to be dealt with in a relatively short time frame. The system was not set up to handle major off-balance sheet risk and derivative-related exposure. The systematic risk that resulted from interconnections of commercial and investment banks that in the end spread to real economy. Pro-cyclic delevering. The loss of confidence in banking system, especially with respect to solvency and liquidity of many financial institutions. The massive problem resulted in credit crisis with available of credit contract and the public sector backed by taxpayer injecting liquidity into financial markets. The government were forced to guarantee merger deals between banks, putting taxpayer dollar at risk. In addition, US authorities injected equity capital into some banks, giving rise to concern that US banks were being nationalized. These problems spread like virus around the world, causing nearly unprecedented global contraction of liquidity. The Basel Committee is an attempt to insulate bank, whereas broader economy from future shock has implemented significant changes. Some have already taken effect, others will be faced over the next few years. The reform instituted by committee focuses primarily on strengthening the regulated capital framework. Changes to be discussed in greater detail, and they include rising capital standard both in terms of quality and quantity. In addition, the transparency and control of banks will be improved, strengthening the risk of capital framework by increasing capital requirement for trading books and complex off-balance sheet exposure, requiring a leverage ratio to supplement risk-based capital requirement, promoting counter-cyclical buffer to offset pro-cyclical amplification of financial shock, instituting policies to address systematic risk and interconnection of financial sector, including a global liquidity standard which will include liquidity coverage ratios, net stable funding ratios, and the use of monitoring metric. Changes will be made at the bank level, called the microprudential level, to improve the resilience of individual financial institution in time of stress. Reforms also target microprudential or system-wide risk built up across the banking system. So, to summarize, there are 6 points: raising the capital standard, strengthening risk coverage of capital framework, requiring a leverage ratio, promoting counter-cyclical buffers. This is against the pro-cyclical delevering point, which was happening. Then institutional policies to address systematic risk, instituting a global liquidity standard. So those were the main goal here to move into this thing. So these were the reasons and the aims that we were targeting in the Basel III norms. And there are 3 tier capital introduced. To understand it, let's look at the capital requirement. So bank capital is used to provide cushion against losses. Banks are heavily leveraged and can sustain really small losses before becoming insolvent. There are 3 categories of bank capital: tier 1, tier 2, tier 3. Tier 1 has the most stringent definition, whereas tier 3 has less stringent definition. The tier 3 capital which are only allowed to cover market risks and will be eliminated with the new standard. So tier 3 which are allowed only for market risk, they will be eliminated with the new standard. And tier 1 is the most stringent definition. So the tier 1 is strict while tier 3 have less strict, and tier 3 are used to cover market risk and will be eliminated in the new standard. Improving quantity and quality of the capital base is the key goal of Basel III reforms. There have been inconsistencies in the definition of capital across countries. As such, it has been difficult for the market to assess relative quality of capital across institutions. And to remedy this inconsistency, the committee will require tier 1 capital primarily consist of stock and retained earning. So there is a list of tier 1 capital that consist of common shares issued by bank, stock surplus, that is paid in capital, retained earning, common share by consolidated subsidiaries of the bank, minority interest, accumulated other comprehensive income, and disclosed reserves. Note that unrealized gains or loss recognized on the balance sheet are under review, but at this point no adjustment are being made to remove them from tier 1 capital. So unrealized gain or losses on balance sheet are under review. Regulatory adjustment applied to calculation of common equity tier 1. The committee has developed strict criteria to describe common share. To be classified as common share for regulatory purpose, the criteria is as follows. Shares have the most subordinated claim on liquidation. Investors have a residual claim on asset. The principal is perpetual and never repaid outside liquidation. Investor must not expect buyback of their own stock, even though they might occur. Common stockholders take the first and proportionally greatest share of any losses that occur. Capital is not realized as liability but as equity. Stock is directly issued against paid in with no mechanism for bank to directly or indirectly provide funds for the purchase of the stock. So additional tier 1 elements contain instrument issued by bank to meet the criteria for tier 1 capital that don't make common equity 1, stock surplus from issuing tier 1 capital shares, instrument issued by consolidated subsidiaries held by third party that meet the criteria for inclusion in additional tier 1 capital, do not meet the requirement for common equity tier 1 capital. Regulatory adjustment applied to calculation if tier 1 capital is it is assumed tier 1 capital. Now there are some rules that are made for tier 1 capital, and there are some criterias. Now those criteria are: instrument should be issued and paid in, subordinated to depositor and other liabilities, is neither secured nor guaranteed by the issuer, is perpetual, callable by the issuer only after 5 years. Banks must not create expectation that share will be redeemed or repurchased. Dividend coupon must be fully at the discretion of issuing institution, must not trigger default. Dividend coupon must be paid out of distribution items. Dividend coupons cannot be reset banks on bank's credit standing. The instrument cannot contribute to liability exceeding asset if balance sheet insolvency test is performed. Instrument classified as liabilities must have principal loss absorption through convertible or write down. The bank cannot have funded the purchase of instrument or have influence over the investment of instruments. In sum, tier 1 capital must be comprised of securities that are subordinated and fully discretionary non-cumulative dividends or coupons, and be perpetual with no incentive to redeem. At this point, innovative hybrid capital instruments with an incentive to redeem are limited to 15% of tier 1 capital, but phased out in the new guidelines. Then there are tier 2 capital. So that was the tier 1 capital, the strict definition that we were talking about, that they should be paid in and subordinated to the depositor, and they should be neither secured nor guaranteed, should be perpetual, and the instrument should not contribute to liabilities accessing assets if balance sheet is insolvent. So a very strict rule of definition. Now tier 2 capital has the following: instrument issued by banks that are not held in tier 1 capital but met requirement for tier 2 capital. Stock surplus from the issuance of tier 2 capital. Instrument issued by consolidated subsidiaries of the bank and held by minority interests that are included in the tier 1 capital. Loan loss provision. Regulatory adjustment applied in the calculation of tier 2 capital. So the tier 2 capital rules and the criteria are: instrument must be paid in and issued, subordinated to depositor and other liabilities of the bank, is neither secured nor guaranteed by the issuer, has a minimum maturity of 5 years with no incentive to redeem capital in the remaining 5 years of maturity, callable by issuer only after 5 years. Investors must have no right to accelerate the repayment of the scheduled repayment of the interest payment. Dividend coupon cannot be reset based on bank's credit standing. The bank cannot have funded the purchase of instrument or have influenced over the investor of the instrument. So regulatory adjustment include but are not limited to: deducing goodwill and other intangible asset from common equity. Deducing deferred taxes must be deduced from common equity. Deferred tax must be netted with deferred tax liability. The amount of cash flow hedge reserve related to items that are not at fair value, such as projected cash flow, must be deducted from common equity if positive and added back if negative. So regulatory adjustment may also be made to deal with increases in equity resulting from securitization and unrealized gain on losses, and due to the change of the following: the bank's credit risk, defined benefit pension funds, investment in treasury stock, reciprocal cross-funding of capital designed to inflate the capital position of the bank, investment in the capital of banking, insurance and financial companies outside the scope of regulatory consolidation where the bank owns more than 10% of the issued common equity, former deduction under Basel II for certain risk exposure. So given all components of capital, the following capital standard must apply: common equity tier capital must be at least 4.5% of risk-weighted assets at all times. Total tier 1 capital, common equity tier 1 was plus additional tier 1s must be at least 6% of the weighted capital. Total capital tier 1 and tier 2 must be 8% of the risk-weighted capital. Now there is capital transparency. To improve capital transparency, which in turn should improve market discipline, the committee will require to disclose following: a full reconciliation of capital elements back to the balance sheet in audited financial statement, a separate disclosure of regulatory adjustment, a description of limits and minimum capital requirement. Example: common equity tier 1 must be at least 4.5% of the risk weighted asset. A description of the main feature of the financial instruments issued to meet capital requirement, an explanation of the capital ratios, for example a complete explanation of inputs and calculation of common equity tier 1 risk weighted asset ratio. Websites must also make available the terms and conditions of instrument and used to calculate regulatory capital described during the transition and components of capital that benefits from provision. Now there is a transition phase. The committee does not expect bank to meet the new capital standard immediately. There will be a transition phase which allow the banks to meet the new standard through earning, retention and raise of capital. To support the broader economy, the committee wants to see the bank continue lending. So implementation will not begin until Jan 1, 2013. At this point, bank and other members must follow the following capital requirements. So 3.5% common equity tier 1 risk weighted asset up from the current 2% requirement, 4.5 tier 1 for risk weighted asset, 8% of total capital for risk weighted asset. Additionally, common equity tier 1 and tier 1 requirement will be placed between Jan 12 and Jan 2015. Now banks will also be required to build up capital conservative buffer which is intended to protect bank and provide an extra cushion. The capital conservation buffer can be drawn down and incurred, protecting the bank from violating minimal capital standard. Fourth, in Basel 2, the 2.5 buffer comprises of common equity tier 1 and is established above the minimum capital standard. The capital requirement previously described must be met before a bank can contribute to capital conservation buffer. In effect, it raises the overall common tier 1 equity to risk weighted assets ratio 7%, the 4.5% required previously discussed plus 2.5% of capital conservation buffer. The bank must meet all the minimum capital standard but has 0% capital reconsideration is subject to constraints on capital distribution. The banks are restricted from paying dividend, buyback or even making discretionary payment to the staff. So that was regarding the tier 1 and tier 2 capital. We'll now continue with the risk coverage and risk coverage. Then we'll look at the stress test and wrong way risk. Then external rating, then counter-cyclical buffer, improving systematic risk management and improving liquidity risk management in the coming part of the same video. So we now move to the risk coverage part. The committee not only believes that capital requirements should be increased in banks across the globe, but believes that capital framework must capture measure of balance sheet risk. Reforms to counterparty credit risk framework became effective from Jan 2013. Reforms were needed to address CCR, credit valuation adjustment, mark-to-market losses on expected counterparty risk and wrong way risk. So major guaranteed institutions saw that their own credit worthiness eroded simultaneously with the value of the asset they were guaranteeing. This is a wrong way risk. An example would be institutions sold credit default swaps and then they saw their firm position declining along with the value of underlying assets. So an institution that sold credit default swap saw their own financial position declining along with the value of underlying assets. So the goal of these changes is to require or to hold additional capital if they engage in large derivative and trading business. Bank incurred losses due to counterparties who defaulted or from CVA related to market losses on non-funded counterparties. OTC derivative trading resulted in significant CCR losses for many financial group in 2008-9. The failure of Lehman Brothers attention on the CCR in trading books at financial institution. The bottom line is that banks that have significant business in this area will see capital requirements significantly increase as they will be required to risk weight of balance sheet items 4 to 6 times greater than commercial loan which has 100% weight. The committee's primary objective with respect to counterparty credit risk is to ensure that capital frameworks capture the risk. So while the changes are complex, they appear to be 3 overriding goals. So these 3 goals are: increase the risk weighted of systematically important financial intermediaries by increasing the correlation assumption. The idea is that correlation between financial institutions increases during a crisis and higher than correlation with non-financial counterparties. The new rule requires 1.25 multiplier applied to existing Basel through correlation assumption. The multiplier effect applies to the following: all regulatory financial institutions with total assets greater than 100 billion, unregulatory financial institutions regardless of their size. Firms are included if their business is lending, securitizing, managing finance, leasing, proprietary trading, other financial services. Now increasing the CCR risk weighting for banks that use internal model by requiring bank to calculate effective expected positive exposure. Not all banks will approve to the use of internal models. That is when internal method is used. An additional capital charge to cover increased credit valuation adjustment during 1 year due to widening counterparty credit spread. So these are the three goals. Now we move ahead, and bank must use the greater of portfolio level capital charges based on EPE using current market data, and portfolio level capital charge based on effective EPE using stress calibration. The greater of two should be applied on a portfolio level and not on the counterparty by counterparty basis. The stress calibration should be applied to entire portfolio of counterparties. Bank must add capital to cover default risk due to CCR as well as capital change to cover risk of mark-to-market losses. Example, CVS. Bank with internal method approval will use different formulas to calculate CVA capital charge than those that have not been approved to use internal model. Those financial institutions with approval use a standard model described by committee. External board rating used in part to calculate CVA risk capital charge. Bank will include a value at risk on CVA under both normal and stress scenario. Additionally, CVA risk capital charge used is tied to credit spread risk, both specific and general. Now the VAR used to calculate is the sum of non-stressed and the stressed VAR component. The period of the stress should be the most severe 1 year stress period in the 3 year stress period used for exposure parameter. The stressed VAR calculation will be examined later. This charge is the standalone market risk charge for all OTC derivative counterparties. Hedges used expressively to mitigate CVA adjustment are eligible to be included in VAR model. It is important to note that just because a bank has a hedge that could mitigate CVA, but the hedge is not being managed specifically to mitigate CVA, the hedge will not be eligible to offset the CVA with the standalone VAR calculation of the CVA risk capital charge. The new framework recognizes that there is a time component to the risk that is missing from the Basel II requirement. As such, the new measure have increased the margin period of the risk. For that, modeling exposure at default, a floor of 4 to 5 business days for netting type repo transaction and 10 business days for all other netting set is imposed. Now stress test and wrong way risk, the bigger heading here. So wrong way risk results when exposure by a bank to counterparty is adversely correlated with the credit quality of the counterparty. So with respect to wrong way risk, a bank uses stress test and scenario analysis designed to identify risk factors that are positively correlated with creditworthiness of the party. Stress test scenario must address the possibility of severe shock occurring when the relationship between risk factors have changed. Banks should identify and monitor and control wrong way risk from the perspective of industry, region and product line. Bank must rate each counterparty separately in order to determine exposure to wrong way risk. In addition, it is determined that banks are exposed to wrong way risk if future exposure to a counterparty is highly correlated with counterparty probability of default. Banks must implement stress testing program, which should include the following 6 elements. Now I move to these 6 elements which are a part of stress testing program. Complete trade capture and exposure aggregation across all type of CCR and not just OTC derivative in a time frame that allows bank to conduct stress test. Exposure stress must be performed at least monthly. Tests concerning factors such as interest rate change, foreign exchange, credit spreads, equities and commodity prices should be performed. Multi-factor scenario to test non-directional risk should be performed quarterly. These tests might include yield curve exposure, basis risk and so on. Joint stress tests of exposure and creditworthiness should be performed at individual counterparty group. Stress testing should be integrated into the overall risk management plan and reported to senior management. Senior management must take a lower integration of stress testing risk into risk management structure and culture of the bank. For day-to-day risk management, lesser sensitive but greater probability event should be considered. Extreme shocks must also be considered. Bank should conduct reverse stress test to identify extreme but plausible scenario. In general, a bank must perform extensive CCR risk reviews not less than once per year, documentation of CCR management, the origination of collateral management unit under CCR unit, integration of CCR measure into the overall risk management of the bank, accuracy and complaint of CCR model, verification of accuracy and appropriateness of volatile and correlation assumption, backtesting to verify the accuracy of model used by bank. So that was about the CCR. So counterparty credit risk or the CCR is an important part here in the stress test and the wrong way risk. So I now move to the external rating part, and the committee require bank to assess the credit risk in exposure to individual borrower, issuer, bond or counterparties. They must assess the risk whether or not the borrower has an external credit rating, especially in case of unrated exposure. The bank must define if risk were to predict and risk weight it appropriate to the actual risk. If the risk is higher than the risk weighted implies, the bank should consider high degree of credit risk in evaluating overall credit adequacy. External credit rating agencies, also known as external credit rating assessment institution, in the committee's reports must meet the following criteria: objectivity, independence, transparency, disclosure information, resources and credibility. The assessment of ECEI must be publicly available along with procedure, methodology, assumption, key element and underlying assumption. Banks are not allowed to cherry pick the assessment of various ECEI or arbitrarily change the use of ECEI. They must use proper and the same rating agency for risk management. Then we move to the leverage ratios. As previously noted, a build-up of off and on balance sheet contributed significantly to the recent financial crisis. Many banks had strong risk capital ratios while at the same time were experiencing significant increase in leverage. Since banks had rapidly deleveraged procyclical at height at the financial crisis, the downward pressure on asset prices were magnified. This resulted in the loss of bank, decline in capital, contraction of liquidity. The committee has introduced a non-risk based leverage ratio that is meant to act as a supplement to measure risk-based capital standard. The leverage ratio is intended to be simple and transparent. The committee has the following objective concerning leverage ratio. The ratio should help constrain the build-up of leverage in the financial institution and the banking sector, which in turn should avoid destabilizing leverage as occurring as recent crisis. Provided a simple backdrop measure of the leverage that supplements and reinforces the risk capital. The committee will test Tier 1 leverage ratio of 3% during January 1 to January 1, 2013 to 2017. Again, the ratio is meant to be simple and non-risk based. Banks will be reporting from 2015. So, they look at a Tier 1 leverage ratio of 3%. The numerator will consist of high quality asset, the definition of Tier 1. The denominator will consist of off and on balance sheet like derivatives, stand-on letter of credit, acceptance and so on items or exposure. In essence, the ratio means that the banks will be able to lend up to 33 times of their capital, which is far less than some banks have done in the past. The ratio effects put on a cap on the bank risk separated from higher capital standard. Then we move to the counter-cyclical buffer. Now, excessive credit growth followed by downturn can lead to a massive losses in financial sector. A vicious cycle and ensues the losses in the banking sector spread to real economy. The cycle is called pro-cyclical amplification. Counter-cyclical buffers are meant to protect banks by ensuring that capital requirement takes into account the macroeconomics. So remember this pro-cyclical amplification. So it's cyclical and it's bound to happen. So to have that, we should have counter-cyclical buffer to protect the bank and ensuring that capital requirement taken into account. Now, the pro-cyclical the counter-cyclical. So pro-cyclical are the financial shocks because they come in cycles after some time. So bank authorities in individual countries are expected to monitor credit growth. If it seems excessive, then there is increase in system-wide risk. The buffer must be implemented. So, however, it appears that this would be an infrequent occurrence. The counterparty buffer include natural authorities monitor credit good. Authorities also monitor other factors that could sign increase in system-wide risk. There is a problem. They require a countercyclical buffer. The buffer is released when the system-wide risk subsides. Internationally active banks which are subject to buffer requirement in multiple jurisdictions. The bank-specific capital buffer for international bank is weighted average. The buffer will extend capital. The offer will be between 0 and 2.5% of the risk depending on the total. Bank will be given time up to 12 months to meet the new requirement. The offer regime will be phased between Jan 1 2016 to Jan 2018. It will be effective by Jan 1 2019. The requirement will be 0.625% of risk weighted asset by 16.625 year to reach 2.5 by 2019. So that's a long way where they have to improve this counter-cyclical buffer. Now we move to improving systematic risk management. The interconnected of many global financial instruments continued the financial meltdown. Systematic important financial instruments, as the committee terms them, should be able to absorb shock and not transmit them. Policymakers worldwide are considering alternative for dealing with large interconnected institutions. The committee is considered several options for dealing with systematically important institutions: capital surcharges and contingent capital, and bail-in debt. So contingent capital, this is a subordinated security such as preferred stock or subordinated debenture that converts into equity after a certain amount of time. The conversion feature is a contractual. Investor understand under certain condition the security will convert to equity. Trigger could be erosion to a bank's capital position or the bank's capital ratio. Bail-in out debt. Like the contingently capital, securities convert to equity under certain condition. However, the bail-in debt, the contractual mechanism that triggers conversion, extends to senior debt maturities of the issuing bank as well. The approach will be integrated and could be a combination of the previously mentioned. In addition, changes to capital requirement will also address the interconnected administration systematic risk, which includes providing incentives for banks to use central counterparties, higher capital requirement for banks with large trading and derivative business, correlation of financial sector firms increased during the time of strength. Thus, higher capital requirement for interfaith sector exposure will be implemented. To improve the maturity mismatch of many banks, new liquidity requirements will penalize banks for excessive reliance on short-term interbank funding to support long-term assets. Now we move to the last topic, which is improving liquidity risk management. So we'll look at changes intended to improve the management of liquidity risk, including liquidity coverage ratios, net stable funding ratios, and the use of monitoring metrics. Now the committee recognized that improving capital requirement is not sufficient to protect financial sector. The committee introduced internationally coordinated global liquidity standard intended to improve management of liquidity in financial institutions. The rapid reversal of readily available low-cost funds to bank exacerbated the recent financial crisis. Liquidity evaporated in globally. Markets were illiquid for extended period of time. Central banks around the world had to intervene, not only to the market level, but in some case institutional level. The goals of liquidity standards are therefore threefold. The first is promote short-term resilience. Second is promote resilience over long-term. And the third is to develop a set of common metrics. Now let's look at one. Promote short-term resilience of bank liquidity provided by ensuring that the bank has access liquidity during acute short-term stress event even as a 30-day horizon. To that end, committee developed a liquidity coverage ratio. The stress scenario assumed downgrade of bank credit rating, loss of deposit, loss of unsecured wholesale funding, increasing secured funding haircuts, increasing derivative collateral. The bank will hold high quality liquid asset that can be converted into cash at times of acute stress. Second is promote resilience over long-term framework, creating incentive banks to fund activities with more stable sources of fund. To that end, committee developed the net stable funding ratio. The committee has developed a set of common metrics to monitor global liquidity risk. Factors such as maturity mismatch, wholesale funding concentration, and the availability of unencumbered assets must be monitored by bank supervisors. This is a macroprudential approach to monitor liquidity, while liquidity coverage and net stable ratios are bank specific, that is macroprudential solution. So that was all for the Basel committee on bank supervision, and a lot of theoretical, but I'll try to conclude some of the points here. and I'll see you in the next session. Would be for international framework for liquidity risk measurement, standard and monitoring. Thank you for watching this. I hope this added something to your current knowledge base.